Fears of a US recession after a worse-than-expected jump in US unemployment data tanked global markets in recent days.
The increase in unemployment actually triggered an indicator that's been traditionally a very good leading indicator of a recession. And so the markets then said the Fed hasn't done enough and we go into recession. And then equity markets panicked.
Markets around the world have dropped amid fears that the U.S. economy is heading for a slowdown. The Nikkei index out of Japan fell by more than 12% at close. That's the biggest one-day dip it has seen since 1987.
The good news is Japan has recovered a lot of the losses from yesterday, and that the declines we're seeing in other markets in recent days, although significant and quite large, they are not in that sort of order of a crash, and certainly the panic has been taken out of global markets today.
Locally, more than $100 billion was wiped from the Australian Stock Exchange in 2 days.
We're watching it very closely. I think things have settled down a bit today, but it was one employment number in the United States. And so I think we just need to have a little bit of caution and a little bit of calm.
The fireworks on the financial markets were in stark contrast to the Reserve Bank of Australia's cash rate decision today. For the 6th consecutive meeting, nothing happened. The cash rate remains on hold at 4.35%.
For now, the board judges that the level of the cash rate is appropriate for balancing our inflation and employment objectives, but there is still some considerable uncertainty about the outlook.
This is a welcome decision from the Reserve Bank because it recognises the pressures that people are under, the progress we've made on underlying inflation, but also the severe market volatility we've seen and global economic uncertainty more broadly. Australians are doing it tough enough already. The last thing they needed today was more cost of living pressure.
This is bad news for Australian families, that following from the government's budget, it is very clear it's going to take longer to get back to the target level of inflation.
The RBA boss says inflation is proving persistent. The central bank now expects underlying inflation will not get back to the middle of its 2% to 3% target band until December 2026, 6 months later than forecast in May.
Getting inflation down is really the key to this ultimately being resolved so that households can just get on with their lives and not have to worry about this.
They are trying to balance this risk between an economy that's not slowing down enough to bring inflation to target, that is, to put this cost of living crisis behind us, versus raising interest rates to try and get that cost of living crisis under control, but not knocking the economy into recession by destroying jobs.
But while there was no movement in the cash rate today, there has been speculation the RBA will deliver a rate cut by Christmas to boost the economy.
What I'm trying to tell the markets today is that I think expectations for interest rate cuts are a little bit ahead of themselves.
They're saying, no, we'll sit and watch, risks are balanced, and it's probably not coming this year. First half of next year, I think, is probably live for a rate cut. We've got May as a first rate cut. It could come earlier, it depends on the data.
I think the message today from the RBA is that the inflation risks have not gone out of this economy and that they are going to remain vigilant, and they could raise rates again before the end of the year.
While markets have steadied, the talk of a US recession and what it would mean for Australia and interest rates here isn't going away.
The RBA is not forecasting a US recession in these latest updates that they provided today. So this is something the markets will remain focused on given the developments of the last week or so. And of course, this is why you'll continue to see markets talking about rate cuts. But in reality is, if we don't get a US recession, if the US economy proves resilient once again, because it has been resilient this last few years, then we focus back on these inflation risks here.
After her predecessor, Philip Lowe, got into trouble for suggesting rates would stay low until 2024, today, after 13 rate hikes since 2022, Michelle Bullock wasn't giving much away.
with our forecasts as they are, you will see, as I said earlier, that we're getting back into the band at the end of 2025. Lots of uncertainty around that, and lots of things can go wrong on either side. So we just have to be alert.